In 2023, just 8 trading platforms accounted for 91.7% of the market depth measured by Kaiko across Bitcoin, Ether, and the 30 largest crypto assets. That sounds like a liquid global market. It also means that most of the visible exit was concentrated in a very small number of places. And the orders inside those venues were not promises. They were quotes placed by firms willing to risk their own balance sheets until the risk changed. After FTX and Alameda collapsed, 1% market depth across the market was still roughly 50% below its pre-collapse level a year later, even though prices and trading volume had recovered. The liquidity had looked like a feature of the market. In reality, much of it belonged to a network of professional traders that could reduce it, move it, or remove it. This is the machinery behind the screen, and the reason a token can look easy to sell right up to the moment everyone tries to sell it. Welcome to Block Docs. On a centralized exchange, a market maker posts 2 prices at the same time, a bid to buy and an ask to sell. The gap between them is the spread. If a retail trader buys, the market maker may become the seller. If another trader sells seconds later, the same firm may become the buyer. The firm tries to earn the spread, collect trading rebates, or capture price differences across venues while keeping its inventory risk controlled. The important word is inventory. A market maker is not a public utility. It is a risk-taking business. Every quote exposes capital. Every filled order changes what the firm owns. If that position cannot be hedged cheaply somewhere else, the quote becomes dangerous. So the firm changes the quote. It can widen the spread, reduce the size displayed at each price, shift capital to another venue, or stop quoting altogether. That does not make the original liquidity fake. It makes the liquidity conditional. The interface gives traders several numbers that appear to answer the same question. They do not. Volume records. Trading that already happened. It tells us activity existed, but not whether the next large order can be executed near the current price. The spread measures the distance between the best buyer and best seller. A tight spread is useful, but it may cover only a small quantity. Market depth measures how much real buying and selling interest sits around the current price. This is where size begins to matter. Slippage is the consequence, the difference between the price a trader expected and the execution the market actually delivered. 2 tokens can print the same daily volume and show almost the same top-line spread. The one with less depth produces a much worse exit. S&P Global's 2025 review of crypto liquidity used all 4 measures: volume, spread, depth, and slippage, because no single one describes the full trading experience. Its data also showed that crypto liquidity remains fragmented by asset, pair, and venue. Volume tells you that trades occurred. Depth tells you what the market might absorb. Slippage tells you what the exit actually cost. Market makers do not spread capital evenly across every token and every exchange. They prefer venues where they can hedge, settle, and withdraw reliably. They prefer pairs with enough natural order flow to offset inventory. They also care about exchange credit risk, fees, regulation, and access to banking. This creates a feedback loop. More traders attract more market makers. More market makers tighten spreads and deepen the book. Better execution attracts more traders. The strongest venues become stronger, while smaller venues may show a market without possessing an independent pool of risk capital. The Financial Stability Board warned that one or a small number of multifunction crypto intermediaries could become fundamental sources of liquidity through proprietary trading, market making, order book maintenance, and client execution. Concentration can improve execution in normal conditions. It also creates a failure point for price discovery when a major venue or intermediary breaks. The hidden risk is therefore larger than exchange concentration. The same professional capital can quote on several exchanges. 5 order books may look independent while depending on overlapping firms, collateral, and hedging routes. The screen shows venues. The risk may be sitting on the same balance sheet. Why would a market maker step back precisely when traders need it most? Because the next trade may carry information the firm does not have. During a fast move, a resting bid can become an invitation to buy an asset whose fair price has already fallen somewhere else. By the time the market maker hedges, the loss may be larger than the spread it expected to earn. This is adverse selection. The firm becomes the slower side of a trade against someone acting on fresher information. At the same time, volatility raises margin requirements. Hedge markets become more expensive. Transfers between venues may slow. A counterparty that looked safe yesterday may suddenly look exposed. The rational response is to quote less size at worse prices. For the trader, that rational decision feels like liquidity disappearing. Both views are true. The order book was real. Its durability was never guaranteed. The collapse of FTX exposed how much crypto liquidity depended on firms that were also exposed to the venue itself. Alameda Research was not merely a large trader connected to FTX. It was an important source of liquidity across crypto markets. When FTX failed, liquidity disappeared from FTX immediately. But the damage did not stay inside that exchange. Market makers and institutions elsewhere had lost funds, faced higher counterparty risk, or became more protective of capital. Kaiko later called the resulting decline the Alameda Gap. Prices eventually rallied. Reported volume returned. Depth took much longer. That separation matters. A rising price can make a market appear healthy, while the amount available near that price remains impaired. FTX also revealed a second liquidity illusion, one inside the balance sheet. According to the SEC's civil complaint against former FTX executive Nishad Singh, FTX valued Alameda's FTX-linked token collateral at market prices even though Alameda and FTX collectively controlled most of those tokens, and only a small portion circulated publicly. The complaint alleged that selling the position would have pushed down the token price, reduced the value of what remained, and failed to generate enough cash to cover Alameda's borrowing. This is the difference between mark price and executable value. The last trade may price one token. It does not prove that millions of tokens can clear at the same level. When the holder owns a large share of the float, the market price can become circular. The balance sheet looks valuable because the token trades at a high price. The token holds that price partly because the balance sheet has not tried to sell. The moment liquidation begins, the assumption destroys itself. In December 2023, the euro-linked stablecoin AEUR offered a smaller and cleaner stress test. Kaiko reported that bid-side depth fell by 96% and ask-side depth by 92% during the episode. Binance suspended trading and later reopened the pairs after liquidity improved. A stablecoin is designed to hold a reference value, but the peg alone cannot manufacture counterparties. When order book depth evaporated, buyers pushed the market far away from the value the token was meant to track. This was not proof that all stablecoins were broken, or that a named market maker manipulated AEUR. It showed something more useful. Even a simple price promise depends on enough capital standing on both sides of the trade. Liquidity is not an asset's personality, it is a market condition. So far, the liquidity in this story has been genuine, but fragile. There is another category, activity designed to look organic when no independent economic interest exists. In October 2024, the U.S. Department of Justice announced charges against several crypto firms and individuals in an undercover investigation of alleged wash trading. The government said trading bots had generated millions of dollars in sham trades across dozens of cryptocurrencies. Gotbit later admitted that it used manipulative trades to inflate token prices and volume for clients. The firm and its founder were sentenced in 2025. The distinction is essential. Legitimate market making places genuine capital at risk to facilitate transactions. Wash trading puts the same beneficial interest on both sides to manufacture the appearance of demand or volume. One creates an executable counterparty. The other creates a statistic. The DOJ cases do not justify calling the entire market-making industry fraudulent. They prove that volume can be purchased as theater at the edge of the market, which is exactly why volume alone is weak evidence of liquidity. The useful question is not, is this token liquid? Ask, how much can be sold? Where, under what conditions, and at what cost? Start with the size of the position. A market can be liquid for a $1,000 order and illiquid for a $1 million order. Then inspect depth within a realistic distance of the mid-price, not only the best bid and ask. Compare more than one venue. If nearly all depth sits on one exchange or in one pair, that concentration belongs in the risk assessment. Watch how the book behaves during volatility. Normal day liquidity is the least demanding test. Finally, inspect the token itself. Circulating float, holder concentration, unlocks, and the share controlled by insiders or treasury wallets. A quoted price becomes less informative when the position that may need to sell is larger than the market available to absorb it. None of this predicts the next price move. It answers a more basic question: whether the exit shown on the screen belongs to the market or only to current conditions. Market makers make crypto tradable. They connect fragmented venues to absorb order flow and turn scattered interest into prices investors can use, but they do not make liquidity permanent. Their quotes depend on capital, hedging access, counterparties, and the belief that the next trade can be survived. When those conditions fail, spreads widen, depth retreats, and the market discovers that yesterday's volume cannot fund today's exit. That is the grand distinction. Liquidity is not the number beside 24-hour volume. It is the amount of risk someone else is still willing to take from you at the moment you need them to take it. And in crypto, that willingness can move much faster than the price on the screen.